All right, good evening, and thank you all for coming back. It's been a while since I've been down here, and from what I told you last time to what I'm going to tell you today, there's been quite a change, and it's for the better. So if there's anything you take away from today, it's that, that Kiwibank guy, kind of optimistic, and he's got a lot more confidence in his call. So if I was to give this presentation just 3 months ago, since the start of the year for sure, but just 3 months ago, the feedback I was getting from businesses was pretty straightforward. We're in a recession. Yeah, I get it. Let's talk about 2025 and 26. No, you don't get it. We're in a recession. These are all the things that I'm having to deal with. Higher costs. I'm now having to lay off staff. I'm worried about my order book. My profitability, no good. My balance sheet, no good. Things are tough, and they're getting tougher. And it seems to have snowballed this year. So that was the feedback, and that's why I ran around with this presentation called Survive Till 25, because quite simply, businesses were not looking to 2025. They were heads down, putting out fires, right? Something's happened. Some good news. Some really good news. The Reserve Bank has finally figured out that we're in a recession. They finally figured out that inflation's returning to target, and they finally figured out a little bit of poking, prodding, baseball bat, that now's the time to start cutting interest rates, and not just a little bit, like a lot. So now I'm saying thrive in 25, and this is me at the businesses saying, yeah, now you can look to 25, and you can look to 26, and you can look with a little bit more optimism, because interest rates are falling, right? What does that mean for households? Yeah. What does it mean for businesses? Yeah. What does it mean for asset markets? Well, every time you open your newspaper in the morning, well, when you're on your Financial Times online, you will hear that the S&P's up. And whenever it is, scratch beneath the surface, and it's because the Fed's cutting, or it's because the Bank of England is cutting, or the ECB, or the Chinese central bank, or maybe it's the Canadians, those crazy Canadians. They've done about 100 basis points already. It's not the Australians. They're a little slow. In general, Australians are a little slow. But we'll drop the breadcrumbs, and they'll get there early next year. Most central banks, excluding the Bank of Japan, because they are their own beast, are cutting. That is fueling equity markets around the world. That's why equity markets are at record highs. When someone says record highs, people go, oh, now's not the time to buy. I'll have a bet with any of you that equity markets will be higher this time next year, because interest rates are still falling, and we've got another year and a half of rates falling. Now, that's not the Kiwi market, is it? We're not equity buyers, are we? We might have $10,000 in our Sharesies account, but we have property. That's our market. That's what we love. And it's an asset market that'll rise next year. 5 to 7%, we think, next year. Not bad, I don't think. Now, I don't want to lift your expectations too much, but I'm about to show you the most brilliantly crafted, beautiful charts you've ever seen in your entire lives. You're going to tell your grandkids about these charts. Maybe not these two, but you'll get the idea later on. I like these charts, and I like these charts because they tell me stuff ahead of time. So manufacturing countries like China, US, South Korea, Japan, UK, Germany. They have confidence indicators, surveys. You can see the massive surge out of COVID, interest rates rising rapidly around the world, causing a recession that lasted for a while. But if you kind of zoom in on this last little bit here, you'll notice that Germany has gone from being really negative to less negative. The UK has gone from being really negative, positive. UK, positive, right? Even after Brexit. China, bouncing around, but positive. US, bouncing around, but positive. South Korea, the story goes on. A big improvement in just 6 months before rate cuts. This was coming before rate cuts. That will continue for all of 2025. Now, this grey is the coolest data set you'll ever see. And if you're struggling to sleep at night, if any of you, struggle to doze off, well, go and get it, because it's called the Dallas Fed Global Real Economic Activity Industrial Commodity Markets, and it goes on. The name's about that long. The description's about 10 pages, but the data's beautiful. The data tells me stuff well in advance of most economic data, especially Kiwi data, right? We're still figuring out what happened in the 1980s. So this here, super fast, bang, went into recession before the other indicators started showing a recession, stayed there for a long time, and 9 months ago, became positive. Of the last 9 months, only one negative. 8 out of 9 is pretty good going. That's positive territory. This stuff includes shipping data, it includes high frequency transactional data. It's a really good indicator. Now, for those of you who know about the New Zealand economy, you know that we are this tiny little collection of islands at the edge of the earth, right? Earth's flat. We're there, miles away. We do a lot of exporting. We do a lot of importing. What happens in the world has a magnified impact on our tiny little island, even that tiny little island that calls itself a continent, Australia. What's happened? Well, we all came out fighting the inflation beast at the end of COVID, right? And we all hiked aggressively as inflation rates went up. Now all these inflation rates have gone down, right? UK's gone from 11% to 2%, Eurozone's gone from 10% to 2%, China's in deflationary territory, bouncing around, US has gone from 9 to 2.3. Just about everywhere except for Australia, they're a little slow, haven't quite gone back, but they are a damn sight closer to their target than they were last year. The global war on inflation's finished. We can talk about inflation in past tense, right? It has returned. Now, you asked about shipping costs. Yep, you remember those after COVID, thanks to China. We did get back to normal. Then we had a spike with the pirates in the Red Sea, not a Johnny Depp movie. And then we've sort of dropped back, and people who I'm talking to expect it to slowly get back to more normal. What I'm saying is there's no inflation there, and if you look at this black line, there's no inflation coming out of oil at this point either. There may do with geopolitical tensions, but right now, there's nothing on here that worries me about inflation. Why is that good? Oh, actually, just before we get there, who likes chocolate? One person admits that. Oh, yeah, okay, now here we go. You're going to thank me later. Price of cocoa beans? Bang. 2 of the largest exporting countries in the world, who do about 80% of trade, Ghana's one of them, have had droughts. So I took this into Whittaker's and said, check this out. Yeah, we know. What are you going to do about it? Well, we have a 12-month rolling contract, and this will start impacting our prices around Christmas. So what do you do? Thank you. Done. Panic buy. I've got bars of chocolate underneath my stairs next to the gold bars. They'll be the same. It's coming. You can't escape it. But without that, our inflation's gone from 7.3 to 2.2. 2.2 is the inflation rate. The RBNZ target's 2. That's pretty much bang on. It'll be below 2 in the next couple of quarters. So they've done their job. I wouldn't say they've done it well, but they've done their job. Scorched earth, yeah, but they got inflation back to where they want it. Where's most of that disinflation come from? What I just showed you, the fall in prices overseas. Of the 45% of goods and services that you consume, that 45% has just gone down 1.6% in price. Down, not sideways, not up a little bit, actually down. We've got deflation that will persist all of next year. Our domestic inflation's a bit more challenging, but it is headed in the right direction. So this is good news. We've even seen some price pressure coming out of housing, right? The cost of metal, the cost of wood, cost of jib has all come off. It's not falling, but the price gains are less and less. So that's good news. We've got some pressure coming out of building. But what I want you to know, what I want you to focus on is this green line here. Rents. Rents have risen quite quickly over the last year, thanks to the migration boom. Rents were running at 4.8%, now 4.5%, still pretty high. That's the fastest rent increase in 1 year that we've seen in the 35 years of the data that we've got. Why is this important? What are you doing as an investor? You're talking about rental yields. Price of the house has gone. Rents have gone. The investor's going to come back because housing's going to get much more attractive for them. I think I went through this with you last time. You've seen this before. I was talking a bit about the disruption, and I was just trying to be clever with a pretty chart. But basically, what I didn't get to tell you was that, well, I did tell you, actually, that insurance premiums, they're going to reprice risk. Well, they have. So insurance for dwellings are up 25% in 1 year. I know many of you have faced this. Even worse if you're in Wellington, up like 30, 35% in a year. Hawke's Bay, don't even ask. Contents insurance up 28% in the last year. Are these prices going to come back down? No, don't kid yourself, right? IAG and these others, they are repricing their risk globally. So even our reinsurance, which is global, it's about a third of your insurance bill is reinsurance. Reinsurance rates have gone up globally because we're getting more weather events. Believe in climate change or not, I don't care. There's been plenty of weather events and they're repricing for it. What some of you will face, or some of your clients will face, is what I consider to be a real threat, and that is, I showed you this last time, IAG believe there are 20,000 homes at severe risk of flooding. 20,000 homes. Then we had a cyclone. So we were preparing and pricing as a bank our mortgage book for sea level rise, but the cyclone taught us that water can also come down, bugger, and sideways too with an earthquake. So we're all repricing our risk. And some people are going to get a knock on the door when this is actually more like 40,000, saying, sorry, you've got an exclusion. We'll insure you for everything you don't need, but we won't insure you for flood. And then the bank goes, maybe we need more equity on that property. And if they come to you and say, sorry, no more insurance, like parts of the Hawke's Bay, the bank will have to turn around and say, sorry, no mortgage. Are we going to lead that conversation? Hell no. We don't want to be the bad guys. IAG's the bad guys. Let them tell the truth, and then we'll react afterwards. This is happening, and it's happening faster than I thought when I spoke to you last year. It's happening now. Now that I've cheered you all up. The good news is inflation expectations have been squashed. So you ask people, where's inflation going? Nowhere. Great. Reserve Bank likes that. That enables the Reserve Bank to go, we're not going to hold out for a very long time. We're actually going to start delivering cuts much sooner than expected. Much sooner than expected. Right, they got it wrong here. That's fine. They did the right thing here. Okay, they did the right thing in August. They cut and they pointed to rate cuts all the way back to 3%. Not my numbers, their numbers. Central bank's telling you that that 5.5% cash rate is going to 3%. That's a big move, right? It's a very big move. Here's my numbers. I'm a little bit more aggressive. I think they'll have to go to 2.5. By that point, it's just a debate, really, whether it's 2.5 or 3. It's not really going to change your life. What's changing your life is going from 5.5 to 3 or 2.5, right? That's the big move. And the big move we saw here in financial markets was savage. Was really savage. We were trading in a range. For you ex-traders, you know we love our ranges, but we were always long. We were always expecting rate cuts to eventually come, because when they do, bang. And we've seen a massive move. So that's why Kiwi Bank was able to cut more and ahead of the RBNZ, was because we got on this ride here. We saw them falling, we passed them on before the Reserve Bank actually delivered them. So you'll notice that mortgage rates are about 100 basis points below the peak, whereas the central bank's delivered 75. It's that little bit extra that we got playing in the market. And this just shows you, back to neutral, they consider neutral to be 275, give or take. Right, so I've got 275 in my mind. Doesn't sound as good as 2.5, so there's my forecast. And you can see what's going to happen the last time we were at these sorts of rates. You know, mortgage rates will drop, I think, just below 5. Term deposit rates, savers, you've been given plenty of warning. Plenty of warning. We've been telling you for a long time that interest rates are falling. So, you know, those of you who went out here with your term deposits, you know, good on you, well done. For the rest of us who have debt up to the eyeballs, we've been fixing for shorter periods in hope of getting some relief. And believe it or not, most of our customers have been doing that as well. 75% of all mortgages are fixed for less than a year. That's really short. Normally, Kiwis like longer rates, you know? Normally, the transmission mechanism, the Reserve Bank says, the amount of time it takes to cut the cash rate for that to feed through to the economy, 18 months on average. This one could be closer to 6, because most of our customers have been taking the 6-month rate. So they'll be rolling off a lot faster than in previous cutting cycles, which means the recovery is a 2025 story. It's not a 2026 story, had it been an 18-month lag. So 2025 will be a better year. Now, this does take into account all banks, right? Kiwi Bank and the 4 Australian Teletubbies, all of us. We are getting more defaults. Ridiculously low levels, very, very low levels, and an unfortunate result from a recession, right? You drive the economy into recession, you cause pain. People get unemployed, businesses fail, and they become forced sellers. But that is not a big, it looks kind of big there, but it's not, trust me. And compared to business and agri, it's very flat line actually. Compared to other banking systems, it is a rounding error. So most of the pain that we're seeing is coming in agri space, around this region as well. But with the results of Fonterra and things are looking better. That's for sure. So what we need to see is I need to see businesses lifting their heads. So cost pressures coming down, that's great. Thoughts of profitability is going up, that's great. What we need is for this to sort itself to enable this, which is investment intentions and hiring intentions. That's growth. When businesses start hiring again, when businesses start investing for the future again, that's growth. That's when I get really comfortable that we're on the right. But we're way away from it, but anyway. So this is a very simplistic chart, put together by a child with a crayon. It's a Westpac chart. And what you can see is consumer confidence going back to the late 80s, had a massive recession back here, 9% unemployment. Global financial crisis, that was my crisis, I was right in the middle of it. Much worse than that looks. And then you see this, and it's like deeper and longer than these other episodes. So what's going on? I think you take it at face value, right? People started off with a cost of living crisis, right? Inflation up, their earnings weren't keeping pace. Then they got slapped with a massive increase in interest rates. After being hit with interest rates rising, their house price goes down 20%. And over the last 6 months, people's thoughts on job security have started to come off the boil a little bit. People are concerned. So households have been hit really hard, but that'll change. That'll change as interest rates go down. Inflation has dropped below people's wage growth, so that there marks the end of the cost of living crisis. And with that, we'll see house prices rising as well next year. All those things that drove people deep into negative territory on their confidence will be reversed slowly but surely next year. That's just a chart to show you that I can go all the way back to 1930. Not really needed, to be honest. Only an economist would do that. Here's our GDP forecast. You can see on a per capita basis, we've had a really, really sharp recession, like as bad as 2008. But you can see our forecast. We're sort of dipping, but then we're grinding out of 2025 and into 26. So we think we'll get 1% to 2% growth next year. That's not flash, but then we'll be back to sort of 2% to 3% in 2026. That's humming along. It's not shooting the lights out, but it's humming along. And that should mean that although the unemployment rate keeps rising and defaults keep rising, it'll peak next year, and we'll see unemployment starting to decline into 2026. So that's good as well. That's a boring chart. I pull that out for accountants. This one here will help you think about the supply and demand dynamics of this country. So we love a migration boom, we really do. We had one at the turn of the century. That migration boom led to an increase in house prices and showed us just how little we had invested in our infrastructure. We lost a few Kiwis to the Aussie mining boom. You could get paid $3,500 a day as a welder in Australia back then, 300 grand a year as a truck driver. Since 2013 though, we've had the largest migration boom in our history. That little lick at the end is people rushing back ahead of COVID. So you can kind of ignore that if you want, but that's the largest migration boom. I moved back to New Zealand here, 2018, and I did some analysis and I said that this here has caused 100,000 shortage in the New Zealand housing market. You may have remembered certain government coming out and going, we should build 100,000 homes. That's where they got the number from. Kiwi built, I'm not putting my name next to it. They built about 5 houses, but the idea was right. Then we had COVID. COVID was COVID. And then the people who would have come here all came here in 1 year. So 3 years, or 2 years, I should say, of pent-up demand, bang. So I want you to look through it. I want you to see that the migration boom that started in 2013 and has not finished. We are attracting thousands of migrants from around the world, or from Asia, and that hasn't dissipated yet. Yes, there's some massive noise, right? Let the other economists explain that. Just look through it. This is heading back sharply, and we think it'll average around 30, 40 a year. That's higher than our pre-boom days. We're simply in a higher level. Who are we attracting? Really young people. Really young, 20 to 30. Most migrants are 20 to 40, right? Almost by definition, they're keen to move country and find a job, start a new life, all that sort of stuff, right? So most people are kind of young anyway, but these ones are very young. They don't buy houses, they rent houses, right? That's the first point. Who are we getting? Food workers, construction, bricklayers, teachers, engineers, nurses, hospitality workers, farm workers, right? Exactly what we've been screaming out for. We've got them in spades. And you'll notice that the labour market has cooled a lot, because the people that we've been screaming for years have actually turned up. The last two categories, salespeople, don't need them. Business analysts and economists, definitely don't need them. But the first 8, very good. Very good, helpful for the economy, detract from the economy. Now, where are they coming from? New Zealand has always been a European story, right? Go right back as far as you like, and Europeans have been, the main source of New Zealand migrants. 2015, India sort of poked its head up, had a look around, like this. And then in the last year, bang, India, miles ahead, right? Who's next? Philippines. And you ask people and you go, yeah, there's Filipino nurses, there's Filipino construction workers. Yeah, we've seen them around, that's cool. Then it's the Chinese. You would have thought China was number one, yeah? Just because they're number one in trade. And then it's Europe, then it's America, maybe some running away from the election. And then you've got South Africa here, which has always been quite a strong surge. I imported my wife about here. I ran out of options locally. On the similar sort of coin, if you like, the other side kind of thing, tourism, which just quietly, when you get people from Asia coming to live here, you get more people from Asia coming to visit here, right? And we've got great links with a country we can't seem to sign a free trade agreement with. We've got great links, right? So, what's our largest export?
Dairy.
No. I knew you were going to say dairy. Tourism. Today, you're right, our largest export's dairy, but that's only because we're back to 85%. If we go back to 100%, tourism is actually our greatest export. And, you know, this is a very good story in that we dropped off a cliff, went through the hardest period you could possibly imagine for the tourism industry, but then we opened our gates and bang, we went back to 85% really quickly, which is good news. But then you ask someone in Queenstown, you know, is it good news? It's like, yeah, well, we're really appreciative that we're here, but we kind of want to be back to where we were. And it's like, yeah, no, fair call. So who's missing? Chinese tourist is missing. Why? China's going through a hell of a time at the moment. Their property market is in crisis. 75% of their cities have recorded massive contractions in house prices. So they're going through a hell of a time over there. Makes sense that they're not travelling as much, particularly to an expensive destination like New Zealand. But our currency will fall and we'll get some more coming back next year. This was just to show you that, you know, we've done some analysis across the regions. South Island looks a little better than the North Island. Things have improved from last year, nowhere near as bad as COVID, but nowhere near as crazy as the post-COVID. And Wellington scored the same as they did last year, 2 out of 10. Everyone else improved, but Wellington recorded the same. Why?
Government jobs.
Government jobs? That makes sense. I think it's just a miserable city. Now, why we want investors back in the game is because house prices fall and it becomes really difficult for developers to develop because it's hard to get pre-sales. And it's hard to get that price you need when you're spending, you know, top dollar to build a house. So you're sidelined, right? And all the indicators are suggesting that construction, resi construction, commercial as well, going to be a little miserable for a while. Don't worry, house prices are already rising very, very slowly, and they should rise 5 to 7% next year based on interest rates, number one, population, number two, and the fact that we're starting with a massive deficit. All we need is the conditions that bring investors back. This is how much lending we were doing to investors. Just 2015, not that long ago. They were active. Investors were hunted by policymakers for years, right? Whether it was the government with their interest deductibility, removal, bright line test out to 10 years, triple CFA, which is a swear word in banking, rate hikes, you name it. There were a lot of things that, and the LVR restrictions that were geared just for investors. There was a lot of stuff that, let's just say I disagree with. Anyway, investors have done this, and for the first time ever, first home buyers are being lent more to than investors. All the investors in New Zealand, all the first home buyers, they're more active than investors right now, which is an outrage, right? It's not an outrage because I don't want first home buyers. I want that line to continue going up and for us to address affordability. But in order for that line to keep going up, the yellow line has to bounce to bring supply. Supply is our problem, not demand. Politicians will tell you it's demand. It's because it's the only thing they understand. You show them that it's a shortage of housing, and that's the way out. That's the way we fix the affordability crisis in this country, and it will happen. So what is reversed? You've got your interest deductibility coming back on. Bright line test, what, 2 years? Takes a council 2 years to reply to your email. That's not going to worry you. Triple CFA being loosened up, LVR restrictions being loosened up, DTIs coming on. Happy to talk about that later.
I want to ask a question because obviously you're saying that house prices are going to go back up.
Yes.
It feels like it's going to be a huge election issue. We've got an next election in 2026, and with house prices on the way up, it feels just like this pendulum is going to swing back again, and it's just going to become very topical. And obviously, interest deductibility has just come back.
Yes.
So it's great that house prices are coming back, but it's going to really influence the next election, in my opinion.
Yeah, and you're not the only one I've heard. So I do this, and I was in Wellington last week, and I said exactly that. I said, what's holding investors back? You know, it's this, that, the next thing. And they said, well, actually, a lot of us have lost a lot of equity in our portfolio, and we need equity to do the next thing. And I was like, okay, so that's going to take a little while to come back. To your point, what's stopping, you know, a Green/Labour government getting back in and then putting the bright line test back out, removing our interest deductibility? And you know what? That's the problem with New Zealand. In a nutshell, that is our problem. It's a 3-yearly cycle. Give them 4 years, right? They spend the first year complaining about the last government, so they might as well, you know, it's like a 3-year, one year forward start. Give them more time, but take these decisions out of politicians' hands, right? Infrastructure is not a decision for a 3-year politician, right? Let's get the councils engaged, get them fired up and thinking longer term as well. Let's have an infrastructure fund that can either fund itself or you can get funding from the government at really low interest rates and pretend it's the super fund. We've all seen the super fund. It's done a great job. Why has it done a great job? Because they don't give a rat's about a 3-quarterly return or a 1-year return. They don't care. They're trying to make money over 35 years. When you have that time horizon, you think so differently. You think incredibly differently. If you had an infrastructure fund that was thinking 35, 50 years, they would gear up. People would gear up into it, and away they go. I always use an example. I got a fencer to do a fence around my property, and he turned up with this old tractor and this hammer thing and banged it out. Beautiful fence. And I said, I need a little bit more. And he came back a couple of months later with this massive rig, like proper machine that you'd expect to see on a mining site. And it just, poof. And I'm like, that thing looks expensive. And he goes, yeah, I've just got a contract with the council to do fences along the motorways for the next 5 to 7 years. That's it. 5 to 7 year contract. He went out and bought a machine, got himself another couple of guys. He geared up. He's ready for 5 years' work. That's how it works in housing.
And you sort of mentioned or touched on debt to income ratios.
Oh, did I now?
Yeah. And I guess there's a bit of interest in the press when all that came out, but will it have much impact, you think, on the market as it stands?
Today, no. Today it won't have much impact at all. Tomorrow, yes. So basically the debt to income ratios, for those who don't know, there's LVRs, there's loan to value ratios. Now there's your debt to your income. So how much debt can you take on versus your income? And they're saying around 6 for owner-occupiers, first home buyers, and around 7 for investors. So you instantly start thinking, well, that's going to cap how much I can borrow, and it will. So how much high DTI lending have we done in the past? So how much lending have we done above 6? Well, this is the run rate, the extreme run rate that happened over 2021-22. Had these debt restrictions been in place in 2019, say, we would have bumped up against that red line as banks. Our speed limit was set. So we wouldn't have created as much cash in the system. It's the banks that create the cash in the system. We create a mortgage like that, poof, here you go. It goes out to you who buys your property, and it comes back in as a deposit over here. We've just created cash. The Reserve Bank's trying to restrain us from creating too much or too little cash, okay? That's what the interest rate does. So this is their way of, without even having to move the cash rate, limiting how much money we create in the system. Because there's no doubt that banks, if you want it, we'll lend it. We'll create it out of thin air. If you want it, if there's demand, most of the time we'll supply it. Right? Most of the time. I'm trying to be honest. It's unusual for bankers. Now, this is where we're running at the moment. So our run rate is kind of half what we're allowed to do. So if you all came to me tomorrow and said, I want a high DTI loan, yeah, we can do it because we'll be nowhere near our speed limit. But we might get near that speed limit in 5 years' time. It's just another thing hanging out there, right, for the next boom. Yeah.
Interested in your perspectives, particularly because you represent a semi-public organisation. There's been a bit in the media about banks chasing record profits, and you're showing us that you've got very low lending at the moment, in particular ANZ's had some data coming out that they're making record profit, and some talk around interest rates not being competitive enough. Where do you sit on that?
I agree. I work at Kiwibank. We're trying to disrupt that the best we can, right?
Why not just keep lowering rates?
Because we've got to fund ourselves.
So you're not able to fund yourself at
Any cheaper than the Australian banks? Hell no. They. If you want to get to the heart of what I really think needs to be done to really fire Kiwibank up, is to get those pricks to use the same risk management tools that we use. We use what they call as a standardised approach set by the RBNZ themselves. And when it says we have to hold, X amount of capital, etc., it's set by the Reserve Bank. ANZ run their own model, right? No surprise, it's a little cheaper than our model, right? So there's this massive disconnect between the big four who get to come up with their own risk models. Banks do blow up on occasion, yet they're running their own risk model, and we're not allowed because we're, too small. That would change part of the game. The other thing that would change the game was obviously giving us more equity, which we're going to get, because that's more money, that's more funding for us. But just cutting an interest rate you can do it for a while, but we've got to service that. So people just think, you can lend out as much money as you like at whatever interest you like. No, you've got to get term deposits in the door. So there was that term deposit chart before. I don't know if you saw it. There was one. So about 70, 80%, oh my God, have I gone past it? About 70, 80% of lending's made up of deposits. Oh, sorry, I can't find it. It was the one where the interest rates were being cut and the retail term deposit rates were being cut as well. So you can come to us for a mortgage, say, at 6%, and someone else can come to us for a term deposit at, say, 5%. And that net interest margin's the key bit. But for us to slash that 6% down to 5%, well, we've got to cover the risk and the cost of the bank and all that sort of stuff. So we have to gut the term deposit rate down to 4%. And then his term deposit just goes to ANZ.
And what's the sort of difference between the amount of term deposit you have and the amount of lending you have?
Like I said, term deposits for Kiwibank are high. They're about 80-odd%. For the other banks, they do a little bit more wholesale than we do. They're like 65, 70%. So most of our funding is like term deposits and those accounts.
So I got one. I was just looking at that graph in particular when I see that first-time buyers are now buying more than investors. And I see that almost like a market correction where funding being able to buy back. Because New Zealand home ownership's decreased over time. So just wondering, is this a good thing that we're giving a bit more home ownership, or are you saying it's a bad thing?
Well,
Deciding over the economy or...
I see what you're saying. Like, investors being out of the market may have enabled some, more home buyers to get in at cheaper prices. I can understand that. But the first home buyers have been in a very steady kind of uptrend for a while. I'm not seeing any sort of massive moves. What I'd like to see in the first home buyers picking up, but that's an affordability issue, which you're right, houses are more affordable today than they were last year and the year before, but they're not affordable for most Kiwis, talking about increasing home ownership rates. So in order for that to go higher on affordability, we need to supply this market with 100,000 affordable homes under 700,000 each, 500,000 each. And that would go a long way to increasing home ownership and solving our problems in general, really.
Thanks. I've got two questions. First one, the risk profile about the banks that you're just talking about, are the other smaller New Zealand banks such as TSB, etc., following the Kiwibank risk profile, or
They have to.
Yeah, they have to. Okay.
Yeah, so all small banks are on what they call a standardised approach to risk management, and because these big four have been around for so long and doing it their own way for so long, no matter how much we scream, this is not fair, it's not an even playing field, the RBNZ has not taken that off them.
Right.
It's kind of helped that we haven't had a banking crisis in this country, even close. Well, I don't think so, but yeah, it has helped that we're pretty safe. I mean, those default rates that I showed you, that rounding error, it's horrible to say, rounding error stuff. Like, I give the Kiwibank board my forecast for unemployment, and then there's a strategy team who use a model, and it just spits out the defaults that are likely to happen. What do we do as a bank? We just put money aside, expecting it to happen. We got really excited during COVID, put a lot of money aside, never used, went straight back into the bank. So sometimes it works, sometimes it doesn't. But that standardised thing is quite a big difference between, the behemoth that is ANZ, that haul their cost of funds so much cheaper than ours.
A follow-up question.
Oh, yeah.
The climate or first-time loans, because clients only need a 5% deposit for that. Are you expecting, this might be out like left field, because in the past people would come up with their 20% and then they become investors because they grow their equity quite quickly. But putting down a 5% deposit now, that is not going to grow as quickly to get to that 30%. Are you expecting that to have a follow-on effect at all?
It might do. It's the first time I've thought about it, to be honest. But yeah, it might do. But most people, in my opinion, and particularly ones you're talking about, are in it for the long term. And if they realise that, if they know that, then it doesn't matter. I bought my first home in Sydney with a 5% deposit, and they charged me $12,000 mortgage insurance because I was below the low.
Yeah.
And I added all this on top, and I was like, oh my God, I've spent $525,000 plus another 12 plus another this. You know, a couple of years later, I've completely forgotten about it, you know what I mean? If you're in there for a while. Yeah, it's daunting.
Oh, it's just something that obviously a lot of people are like, we're waiting for our house to increase in equity. We're like, you know, put 5% down, so it's going to take a bit longer.
Yeah, exactly.
Yeah.
Exactly.
Do you think we'd ever be able to buy shares in Kiwi Bank? And secondly, would you?
Yes, and absolutely. Yeah, I think so. The conversation's moved a long way. I've been at Kiwi Bank since 2018, and if you'd asked me that in 2018, I'd say, from what I'm hearing, that's like a dream, like 10, 15 years away. You know, nothing in the, you know, that was the prior government. Now there's been a change. And they're exploring, and my understanding, I'm not involved, but they're exploring every option to turbocharge Kiwi Bank. They want to turbocharge us, which is great. I have been asked to give advice on how, in my opinion, but Steve Yukovic, he's all over it. He's in there fighting to turbocharge. So yes, I think there comes a day when you'll be able to buy shares in Kiwi Bank. And for me, that day happens, I'll be pinning my ears back. Yep, absolutely. Buying the disruptor in a pretty...
And then you would be very right to Kiwi Bank. Yes, as well.
Yeah.
If that happens though, if Kiwi Bank lists, won't the Australian banks just buy those shares?
Yeah, I guess.
Effectively, Kiwi Bank in no time will be an Australian bank.
God, I'd hope that wouldn't happen, but yeah.
There wasn't some restriction about that, but I mean, why wouldn't you? I mean, it's just a good way to heat up the competition, right? There's suddenly no competition at all.
Yeah. That
So that's kind of
someone you would hope that there's someone that would think of that. That would think. To be honest, we had the perfect shareholders. Right? We had Post, right? Get rid of them. When we joined together, Post and Kiwi Bank 20 years ago, beautiful relationship. They had the network, we had the, you know, what we needed to do, and we grew, right? Then we outgrew each other. Post business changed. Kiwi Bank people don't like going into a stamp shop to do their mortgage. So we've split. So get rid of Post, that's fine. ACC, brilliant shareholder. What do I say about long-term thinking? ACC, massive amount of your money that they are investing for a very long time. They're thinking 50 years, right? I want a 50-year shareholder in Kiwi Bank, right? She disagrees, fine. The other one was NZ Super, and you've already heard about what I said about NZ Super. I'm a massive fan of NZ Super. They were two really cool, and they were ready to pump and prime, but then NZ Super turned around and said, if we're going to invest what we really want to invest, we kind of want to get our money out at some point, you know, not in the next 5 years or 10, at some point. And the previous government said, no, So that fell through. We lost 2 fantastic shareholders. Now we're just owned by the Crown, if you like. I could imagine a variety of ways in which we're divvied up. So long as it turbocharges us, you know, we'll get some advice from Lance Armstrong. Away we go.
The electricity shares that were sold a few years ago, I think it's a good model.
Was that Meridian, was it?
Yeah, Meridian
Yeah.
and Mercury and so on, where the government holds 51% of shares, and you actually have to be a New Zealand resident to be able to hold the other 50% of the shares. Now there are some issues to do with free trade agreements. I think Singapore and entitled to hold those or whatever, but basically that seems to be reasonable.
Seems to work.
To keep it. But basically, you're right to stop the Australian banks are flipping and buying 49%
Yeah,
over time.
yeah. Well, that's maybe the model.
I like it. Hey, just a comment. I lived in Australia too, but the thing that amazes me of the difference between the countries is the poorness of our superannuation system and thinking.
Yeah,
That's 3% here, and what is it, about 12% the employers are having to contribute there?
yeah.
I ran a decent sized business in Australia, and I didn't mind contributing 9-10% that it was at the time, because it was just fantastic, and you get this sovereign wealth. And to me, New Zealand's just pathetic. They're 3%, it's small thinking, it's limiting, and all these employers bleating about we can't afford it drives me nuts, because when you run a business, you find a way to afford it, and it's great for everybody. So,
I apologise for the first 2 rows. I'm going to start spraying right about now because this is right up my area. I love it. Agreed, right? Paul Keating brought that in early 90s, so they've had a massive head start already, and they brought it in and ratcheted it higher over time. When I was there, which was 18, it was still at 9. I think it's just gone to 12. You're right. What I liked is I moved there in 2002, and I got my first job, and let's say I got $100,000, and I was like, okay, great, thanks. Where do I sign? So I signed. Then there's a form at the back going super. I'm like, what the hell's this? Oh, by the way, you're getting, 9% on top. I'm like, oh, well, that's nice, isn't it? So that's 9K a year going into some super fund. Okay, I'll pick that one, right? That was the discussion. I'd gone through a whole lot of interviews. I'd been offered the role, told how much I was going to get paid, and didn't know about Aussie Super. Now, why is that important? Because I didn't have to make a decision. Do you know what's hard for people out there? They get 100 grand and they think, oh, I really want the whole 100? Should I put 2 in? Should I put 3? No, you shouldn't even be thinking about it. It should be compulsory, and it's on top of the 100 that you've just been offered. So it's not even up for debate. And do you know what? 16 years working there, I'm with you. Come back with a little bit of cash that there's no way I would have saved by myself. I'm not that prudent. So Aussie Super, brilliant example, and if I'm right, the fifth largest super fund on the planet, behind places like Norway. It's got oil coming out everywhere. Like, it's an amazing asset that those Australians have grown. We're starting behind and at lower rates. Sure, your company, matches and all this sort of stuff needs to be compulsory, needs to be a very high rate, needs to not be discussed. Oh, and that money pumps straight into the Australian economy. It pumps straight into Australia's capital markets. We don't have money to do stuff. Rubbish.
So where's growth going to come from in New Zealand? I mean, we all work sort of houses one another or whatever else, but actually, as a nation, we've got a deficit with the rest of the world in terms of our annual accounts, and that's getting slightly worse. our sheep farmers are going to go out of existence in the next 5 years. You know, where's the sort of, and we're losing a lot of good talent to Australia. So where's the sort of strategic future for New Zealand? Because we just seem to be running up and down on the spot, and in fact going slightly backwards.
Yep. So there's a lot of areas, to be fair, and I'm going to start off with the traditional area. I remember in 99, 98 sort of era, there was this big push for both Australia and New Zealand to modernise, to become more tech-savvy economies. Go away from mining, go away from dairy. Well, what actually happened over the last 30 years is they have those industries, the Australian mining industry and, you know, Kiwi dairy, meat, all of that, have been some of our best star performers. So I'm going to say that continues. Yes, there'll be problems in some. They'll have to, you know, keep up with the times, but I don't think they die. I still think they'll be a very strong part of our economy. Manufacturers are doing very well, and I think there's more in that space. I mentioned tourism before. We're still a beautiful country. We're still attracting many nationalities down here for the Kiwi experience. I don't think that dies. There's a lot we can do in all these industries to make them more productive. But I'm saying this at a time when everyone is thinking that the next 10, 15, 20 years is going to be completely driven by robots. And it's a very scary thought for most of us, right? It really is. I like to think that it'll enable all of us to do a hell of a lot more with what we've got, and we should embrace. But back of my mind, I know that there are thousands of jobs that could be gone with AI, including mine. All you need is a little avatar on the screen. It'll draw better charts than me. It'll give you a better prediction. I'm done, right? So there's a lot. We do talk a lot about effectively productivity. Where are we going to get a lot of productivity gains from? And there's the AI space. You can see it all in services, but also, you know, in your farm. You know, there are farms out there where the cows milk themselves. You know, there's so much tech that can help us propel and prosper. What have I missed? I think AI will help lift all boats. I think, you know, next year the growth, it is going to be quite broad-based. There's been a lot of pain in retail. Maybe there's a bit of creative destruction in retail. That's an economist's way of saying some of these shops are going to go bust. More of them. But there's a lot of what we already do that we can continue doing really well, and I think better with the technology that's coming. AI is just going to completely change everything. It really is. If you look at what it can do already, you know, you speak to law firms who use this AI tech already, they're not hiring as many interns because they've got this bot that can do a lot of their work for them, right? Accountants and Xero, and you know, the accountants tell me, well, I used to spend 20 hours on this account, 15 hours was just sorting the guy's bloody invoices out. Now I'm giving 15 hours worth of really good advice. So there's, you know.
What happens in the next week when Donald Trump gets elected? Like impose 10% tariff.
Did you say 10%? Did you say 10%? 10% is a money grab. So this is interesting. You need to think about the tariffs in terms of size. If he comes out and says, I'm going to put a tariff of 10% you know he's to his word and he's actually going for a money grab, right? He's not trying to divert behaviour. If he wanted to actually divert behaviour, stop buying China, he would put 25%, because the modelling for 25% tariff shows about that much income for the US. People just divert, they do something else. 10% shows this much income for the US. So I'd be really interested as to whether it's 10 or 25 for starters. If it's 10, there'll be tit for tat, a little bit of this, a little bit of that, not a big diversion of trade or having to get all this Chinese product that cannot be sold and dumped in New Zealand at 1/10 of the price. That might be the 25% one and versus the 10. He's pretty good at annoying people, so he'll annoy Europe, but perversely it's exactly what Europe needs. Europe needs a real kick, right, to get themselves in order. And they've got an energy crisis coming that they're not preparing for, so that, you know, any sort of fire them up would be good. But what keeps me awake at night is that China-US. And the reason it worries me is because, well, one's our ally, the other's our largest trading partner. And you know what happens when Australia says a few things that they don't like. They've already threatened Australia. They've already threatened us. So I really don't like being caught between that, which is why I always come back to India as being, we've got to you diversify your portfolio. You're not holding all the same things in the same town. We need to diversify our trading partners. In India will produce more growth than most developed countries for the rest of my life. And I plan on living for a long time, just to annoy my wife.
Sorry, you mentioned about affordable housing.
Yes.
Where is that going to come from?
You. All that plot of land you have that's sitting there doing nothing.
It's the consent, the cost of consenting. It's phenomenal. Cost of consultants, phenomenal. They make up 1/3 of the cost of a drill. Just consultants and counsel.
Yeah. You know, we sit here and we look at all these problems, right? And I hear you. You know, things are expensive here, incredibly frustrating. The councils, I am sick and tired of hearing from developers saying, I've got land to develop, but the council won't let me because we don't have the pipes. I hear it time and time again, right around the country, okay, whether it's Warkworth, wherever. It's an incredible frustration for us. It's that lack of infrastructure spending over 30, 40 years that has inhibited everything, right? And it's slowing down your approval process. But where there is a will, there is a way, right? We should be able to get around this. We should be able to make it a lot cheaper to build. I've been invited to dozens of modular, prefab, bang, bang, all these examples. And you get these Australians looking at us going, you guys are a little slow, aren't you? Look at what we've done in Australia. I built a hospital in 21 days. And I was like, I want to see this. Flat and bed. They were all modular bed, you know, all had showers, banged it out, 3 weeks, done. It was in the middle of nowhere. That is Australia. But yeah, they are incredible at building big stuff, the Aussies. I don't know why we can't get Leightons or, you know, some of these Australian players down here, get them down here to lose money and then figure out, right, there's got to be a better way. Because they build on scale that we think's, you know, someone's from Mars talking about that size. Actually, no. Aussies build in size. Yes, they've got what we call the economies of scale. They've got more people, they've got more resources. You know, Australia, they call it a lucky country. Why? You dig a hole anywhere in Australia, anywhere. You dig deep enough, there's something shiny at the bottom of it. Coal, iron ore, pink diamonds, match your hair. Gold, copper, LNG, silver, uranium, just in case you want to stir up some trouble.
We've actually had. We're going to wrap up now. Thank you, Jarrod. Just on that note, we've had actually, in the last 6 months, 3 landlords actually come back from Australia. So the grass isn't necessarily greener over there. Thank you, Jarrod, for coming and speaking to us tonight. When we were setting up the event, there was a woman down the back and she said, "Oh, Jarrod Kerr, he was my lecturer from 10 years ago. I didn't understand economics, but now I do."
Still here?
She's around there in the back.
Oh my God.
Thank you for
You
making
poor
it
thing,
very...
I'm so sorry to have started your career like that.
No, thank you for making it really easy for us to digest. I think you also have a podcast, am I right?
Yes.
Okay, what is the podcast?
We've just started it, Markets, Mystics and Mayhem. So you know what you're in for. We try and have a little bit of fun with the economic data, but we always bring it back to the markets. Are they going up or down?
Yeah. Jarrod's going to stay with us, so if you've got any more questions, please feel free to stay and ask more questions. He's staying in the Ibis tonight. He's come all the way down from Auckland. We are building a better hotel. It's called the Pullman, and it's going to be ready in 18 months. So we do want to have you back in 18 months' time. So thank you, Jarrod. It's been awesome to have you here.
Thank you.